but their profits are going to go up a lot more than triple. These stocks should be much, much higher. The reason they're not is because Wall Street still doesn't understand what's going on. And remember, there are really two different buyers. Wall Street, where they buy stocks, they're not buying the physical metals. They're looking at stocks. And they don't understand why gold and silver are going up. And they don't expect the prices to keep going up. In fact, they don't expect the prices to stay up. That's why they've been so reluctant to bid up mining stocks and adjust their future earnings forecasts for higher gold and silver prices. In fact, they're still assuming that gold prices in the future are a lot closer to where they were in the past than where they are right now. Now, indication that maybe that's changing was the action today, because even though gold and silver finished down on the day, most of the stocks recovered all those morning losses and finished positive on the day. They all didn't finish positive, but many of the stocks that I own not only finished positive on the day, but made new multi-year highs on the day, despite gold and silver being down. And what I've been saying is that these sell-offs are irrelevant to the value of these gold mining companies. Gold could go to 3,000 and they'd still be cheap. So what difference does it make if it's 4,600 or 4,500 or 4,300? Doesn't make any difference at all. Gold stocks should be going up every day at this point, regardless of the short-term fluctuation in the price of gold. That has no bearing on what these companies are going to earn now or in the future, and probably even more so with these silver miners, given how much the price of silver has gone up. And again, as I mentioned on my last report, very few people seem to understand that gold companies also mine silver. It just reduces the cost of their gold. And now their costs are going to collapse because the silver byproduct that they're mining when they're looking for gold is now so valuable that it is dramatically reducing the cost of mining gold. But I think the action I saw today is a little bit constructive in that maybe, just maybe, Wall Street is starting to figure out that gold and silver aren't going to crash. And eventually they're going to realize that they're going to keep going up. And they're going to keep going up because of the fundamentals. And the fundamentals are getting better and better for gold and silver with each passing week. So what I would do, again, to buy my gold fund, you can go to the Euro-Pacific website, europac.com, check it out, read the prospectus. Unfortunately, if you want to invest in that fund, you've got to wait until Tuesday because the markets are closed. In fact, mutual funds you can only buy on the close. So I have a feeling that the fund will be up a lot on Tuesday because I expect a big move in gold and silver over the 3-day weekend and an even bigger move in the mining stocks. But if you want to buy physical gold and silver, Schiff Gold is open 24/7. So you can buy Friday night, you can buy Saturday morning, Saturday night, Sunday morning. You can load up. You can go to tgold.com too and make sure you have an account. In fact, every customer of Schiff Gold should also have an account at T-Gold, right? So if you watch this market wrap, make sure that you set up your account at T-Gold. Doesn't matter how much gold you buy or how much silver you buy, just get your account going because I'm going to use this platform as the foundation to build out the ecosystem that will enable my customers and a much broader audience to transact in gold and silver, to use gold and silver as money, as a medium of exchange, not just as a store of value, but as money in commerce, which is what gold and silver are meant to be. Unfortunately, they haven't really fulfilled that role for decades now, but that's coming back. And I think the internet and tokenization and blockchain could play a big part in the revitalization of gold and silver, especially as the air comes out of the Bitcoin bubble and people are looking for viable alternatives. We already know the central banks already found a viable alternative to the dollar, and that's gold. And so this trend is going to gain momentum with the fundamentals that are going on right now. And I covered some of them on Monday. And so I don't want to repeat myself here. Instead, I will refer you to my main podcast that you can find on the Peter Schiff YouTube channel or on Schiff Radio. And I talked about what happened over last weekend that helped fuel the weekend gold rally. And that was the announcement from Jerome Powell that he received a notice from the Justice Department that he is under criminal investigation for statements that he made to Congress about the renovation project of the Federal Reserve building in Washington. So I spoke at length about that, as well as the president's harebrained idea to cap credit card interest rates at 10%, and how this stuff, also the stuff that he's saying about Greenland. I mean, everything that Donald Trump is doing is pushing the world away from the dollar and into gold. I mean, he's not doing it intentionally, but the unintended consequence of the policies that he's pursuing are very bullish for gold and silver. Now, they're bearish for the dollar. The dollar hasn't cracked yet. The Treasury bond market hasn't cracked yet. That is coming, right? Gold and silver are the early warning. To me, it's just like 2007 when subprime blew up. That was the warning that the rest of the mortgage market and the financial system was going to follow. I knew the financial crisis I had been forecasting for years was a lot closer to a reality once I saw what happened to subprime. But the reason that Wall Street was oblivious, the reason that Ben Bernanke said subprime is contained, is because he didn't understand the problem in the economy, in the housing market, in the mortgage market. So from their perspective, it was no big deal what happened to subprime. I knew it was the tip of a huge iceberg. And I appreciated the warning because I understood what the warning was about. Same thing is happening now, right? The financial crisis didn't come until a year later. Subprime blew up in 2007. Financial crisis happened later in 2008. And in fact, in early 2008, people still thought everything was great, right? Even though we were already in the Great Recession. They didn't know about it yet. I knew about it, but they didn't find out until the end of the year when they revised all of the economic data going back a year and said, oh, by the way, we've been in this Great Recession for a year. Well, what happened with gold, what's happening now, I think, is forecasting a much bigger monetary crisis that may hit later in the year or maybe even next year, but in the dollar, in the bond market. So gold is reacting first, just like subprime reacted first in 2007. You saw the broader crisis hit a year later. Same thing's going to happen now, except it's not a mortgage credit that is the problem. It is government credit. It is sovereign debt. It is the debt of the United States. It's not a mortgage crisis. It's a U.S. Treasury crisis. That's what's coming, and a U.S. dollar crisis. Gold and silver are your early warning signs. First it was gold, and now it's silver, and of course platinum. The whole precious metals complex is flashing that the dollar is in trouble, that the U.S. bond market is in trouble. And what Trump is doing is playing a big role in that. But we also have some news that came out this week that I didn't have on Monday when I did my main podcast. So I want to get into this news that is also bullish for gold, and that is inflation and the inflation numbers. So we got the official CPI numbers came out on Tuesday, and the media initially hyped this up as if it was good news, like, oh, see, inflation is going away, right? But here are the actual numbers. So the PPI, and these are December numbers. So the month increase in consumer prices was 0.3. The prior month was 0.2. So it got worse. And if you annualize 0.3, you're looking like 4% inflation. That's double the Fed's 2% target. The Fed is cutting rates. They're talking about rate cuts, and inflation is twice what they claim they want it to be. They should be hiking rates, not cutting rates. And how is this good? Then the year-over-year increase in the CPI, which was forecast to be 2.6, came out at 2.7. So it's worse. It's worse than they thought, right? Yet they're still talking about rate cuts, right? Now, I guess where they got the improvement, right? And this is, talk about making a lemonade out of lemons. But the consensus for the core month-over-month gain was 0.3. And instead, we rose by 0.2. That's what Wall Street was celebrating. That's nothing. I mean, it was 0.2 the prior month, so no improvement, right? And year over year, they were looking for 2.7. Again, this is the core, not the headline. They were looking for 2.7, and we got 2.6, which was the same as we got the month before. But so what? It was 0.1 lower. It's meaningless, right? And remember, the Fed wants this to be 2%. We're not even close to 2%. But what was worse than the CPI was the PPI that came out the following day. Now, the PPI, I think, is more important than the CPI because it's forward-looking, right? The PPI is producer prices. And producers generally feel the pinch of inflation first, right? Because they're buying at the wholesale level, and they get hit with the cost increases. And then they pass them on to their customers by raising their prices. So you would expect that if price increases are coming, that they will show up first at the producer level and then at the consumer level, right? That is the order. So the producer price is more forward-looking. Now, if you look at the producer prices for the month, okay, the overall number was a little bit better than expected at 0.2. But the year-over-year increase in producer prices jumped from 2.7 to 3%. 3% year-over-year rise in producer prices. Much hotter than the 2.7, 0.3 hotter than they thought. Now, the core this time came out in line. They were looking for up 0.2, and we got up 0.2. But that was double the 0.1 that we got in the month before. But here's where it gets real ugly. The core, ex food and energy, year over year, core now up 3% versus 2.6% the month before. And again, for the producer prices were a month earlier. Consumer prices were December. This is November, right? And so that's even worse because we haven't even got December yet. So we're 3% year over year. Ex food and services and trade up 0.2. And here's another number. I don't know if this is the super core or what it is, but it's the producer prices excluding food, energy, and trade services. That was up 3.5% year over year in November versus being up just 2.9% year over year in October. That is a big increase in year over year price increases in just 1 month. And the Fed is cutting rates, and they're talking about more rate cuts in the face of already high inflation going up, right? It's not like we have above target inflation and it's coming down. We have above target inflation and it's going up. Meanwhile, everybody wants to pretend, especially Donald Trump, that inflation is gone, that it's dead and buried, right? That the Fed is just being stubborn and not cutting rates in the face of, vanquished inflation. The reality is inflation was never really dead, and now it's coming back stronger than ever. and the Fed is behind the curve. The Fed should be hiking, and instead it's planning the next cut. This is extremely bearish for the dollar. The dollar is going to roll over. This is very bearish for the bond market. Meanwhile, look at what's going on with yields in Japan. I've been warning about what was going to happen with the Japanese government bond market. I started really warning about it when rates for the 10-year Japanese government bond were about to break 0.5%, 50 basis points, because originally the Japanese government kind of drew a line in the sand and they wanted to defend 50 basis points. And I said they won't be able to do it. Rates are going a lot higher. And I predicted that we would get to 2% and that once we did, we could have a quick move to 3% and all hell could break loose. Right now, the yield on the 10-year Japanese government bond is 2.17%, right? And headed much, much higher. This is going to be a big problem, not just for Japan, but for the United States, because rising Japanese government bond yields are going to put a lot of pressure on U.S. government bond yields, and that is what Donald Trump doesn't want. He's trying to do whatever he can to bring down rates, to bring down interest rates, to bring down mortgage rates artificially, using Fannie and Freddie to go into the market and do a kind of QE on their own by buying $200 billion of mortgages. I think I already discussed that or on my other podcast, so make sure and listen to it. And trying to stack the Fed with his cronies, so they'll go in there and try to buy more government bonds, right? To artificially suppress interest rates that are headed much higher, and a much worse financial crisis is around the corner because, as I said earlier, this is not about, subprime borrowers. It's about the U.S. government being a subprime borrower. The reason the U.S. government was able to bail out everybody in 2008, 2009 was that our credit was still good. Well, now it's our credit that's in question, in doubt. In fact, there is no doubt. We're broke. We can't afford to service our debt, yet we're talking about buying Greenland. I mean, if we don't invade it, where are we going to get that money? We're going to have to go into debt and borrow more money that we don't have. We really should be selling off our property to pay down our debt instead of taking on more debt to buy more property that we can't afford. But the world is not going to fund this, not going to subsidize this. And we are headed for a real crash. Inflation is going to rear its head in a way that few people understand. Obviously, the gold and silver market, when Wall Street is focusing on these backward-looking CPI numbers, they're ignoring the forward-looking action in gold and silver. And again, it makes me laugh when I watch, Wall Street, trying to figure out why gold and silver prices are going up. And their explanations are almost as funny because they don't get it. Because if they understood why gold was going up, it destroys their entire thesis. That's the basis of their recommendation of the overall stock market and the U.S. economy is great. It's not great. If the U.S. economy was so great, gold would not be $4,600 an ounce, right? Silver would not be $90 an ounce if we had a strong economy, right? We wouldn't be running these massive deficits if we had a strong economy. People were making a big deal about the trade deficit, finally took a big drop, and they want to credit Donald Trump for this big drop in the trade deficit and say, hey, maybe it's the tariffs. It's not. The main reason that the trade deficit went down last month is because a boom in gold exports. We exported a lot of gold, right? We didn't manufacture that, right? That's our gold that got exported, and that's 90% of the improvement in the trade deficit for the month was all the gold that left the country. That's not a good sign. Our imports were down, but our exports weren't really up that much. And the main reason our imports were down is because they're more expensive, so we can't afford to buy them. In fact, if you look at China's numbers, China's exports to the U.S. were down, I think, 20 or 30%. Yet they posted all-time record high trade surplus. How is that? they're selling less to America, but more to the whole world, right? So what they didn't sell to us, they sold to the Europeans. They sold to the South Americans. They sold to other Asian consumers. So our loss was their gain. Other consumers got what we could no longer afford. And China didn't miss